Get ready for the next big shakeup in inheritance tax. This time it's not just about estates, but your pensions too. Rachel Reeves and her allies in the Treasury are reportedly plotting a move that could redefine how we pass on wealth, and it's raising more questions than answers. Here's the lowdown on what's brewing and why it's sparking a firestorm of debate. But here's where it gets controversial. The Labour Party, under the watchful eye of Sir Keir Starmer, is allegedly eyeing a plan to tax pensions as part of inheritance calculations. That means if someone dies before they've had a chance to spend their retirement savings, their heirs could face a hefty tax bill. The Telegraph recently broke the story, and now The Guardian is hinting at even stricter rules to limit how much you can give away during your lifetime to avoid inheritance tax altogether. Imagine this. The very act of being generous to your family could backfire if the rules change. A source close to the Treasury told The Guardian that with property values soaring and wealth concentrated in assets like homes, the government needs to tap into inheritances from those who can afford to pay more. That's a polite way of saying they're targeting middle-class families, not just the ultra-wealthy. And here's the kicker. They're considering overhauling the 7-year rule, which currently lets you gift assets and avoid full inheritance tax if you live for 7 years afterward. If this rule is shortened or scrapped, it could upend long-standing estate planning strategies. Worse still, there's talk of a lifetime cap on gifts. Think of it as a tax on kindness, how much you can give to your kids or grandkids before the state starts taking a cut. This isn't just about fairness, it's about control. Reeves has already made headlines by dragging pensions into the inheritance tax net, and now savers are scrambling to transfer wealth before the rules tighten further. The government claims this will raise £1.5 billion annually by 2029 to 30, but critics argue it's a gamble. After all, how many families will simply stop giving altogether if the rules become too punitive? And this is the part most people miss. There's still a loophole called gifts out of surplus income. This allows unlimited gifting, as long as you can prove the money wasn't needed for your daily expenses. It's a lifeline for many, but don't be surprised if the Chancellor tries to close it. While few use it, its generosity makes it a prime target for reform. So what's a savvy saver to do? My advice? Don't wait. If you've been planning to pass on assets, do it now. Not only will you get to see your loved ones enjoy the money, but you'll also avoid the risk of retrospective tax changes. And if you're not ready to hand over large sums, consider alternatives like junior ISAs or child pensions. These vehicles let you contribute up to £9,000 annually to an ISA or £2,880 to a pension, which becomes £3,600 after tax relief. It's a win-win. Your family benefits, and you stay ahead of the curve. But here's the twist. The real beneficiaries of this chaos might be you. If you've been eyeing that dream vacation or a big-ticket purchase, now's the time to splurge. After all, the whole point of saving is to enjoy it, especially in retirement. So while the Treasury plays its game, don't forget to live your best life. And if you disagree with the direction of these policies, make your voice heard. The debate is just beginning, and your opinion matters.